I felt it was important enough that we get together as a board, and I appreciate everybody agreeing to do that. And Chris Katchmar, glad you could join us. For Paul and for Barbara and Eric's purposes, Chris Kelly, who's on here, is from OGAT, and he'll be recording this meeting for OGAT. Wants to try it because if this works, they'll probably be using the template, if you will, for other meetings going forward for the town of Orange, which I imagine many will be run this way in the next several months at least. And Ron Davis is the executive coordinator for OGAT, and he's listening in also because he wants to make sure we can do this. And there may be some other people that join in. There was a big email that some of you may have seen, curious as to how we could do this, so we are doing it. So with that, I'm going to shut up and let Eric run the meeting.
Thanks, Mitch. So we'll call the meeting to order at 7:04, now that I see that we do have a quorum, which is good. And call your attention to the agenda. We really only have one item on the agenda, which is to review the recommended portfolio rebalancing as Chris from Fiduciary Investment Advisors has put a schedule together. Hopefully everybody received Chris's email today with the schedule.
Yes.
Yep.
Okay.
Got it, great.
So Chris, maybe what I'll do at this point is turn this over to you, and you can kind of walk everybody through, you know, what your proposal is for us and reasons why, et cetera.
Okay, well, great. Thanks, Eric, and good evening, everyone. Bear with me here on the tech front because I'm going to open up, if you're all able to as well. I don't know what it means for my camera, Chris, but hopefully I'm doing this okay. I was going to open up the slide deck as collateral, if people can do that. And you should see it's labeled market update. Everyone have access to that?
I've got it by paper. I printed it out.
Oh, great. My printer's on the fritz, Mitch, so I wasn't able to, so bear with me here. But if people have that slide deck and they're able to turn to page 3.
Yep.
I think you've all got a pretty good sense of what has gone on in the markets the last couple of weeks. We have had, as you all well know, a complete re-rating of capital markets. And that re-rating has occurred really across both the equity and fixed income spectrums. You see there really most acutely in the month of March, the downdraft that's been experienced for the first few weeks of the month. And you can see there in the upper left-hand corner, the S&P index down almost 22%. Work your way down that column a little bit if you can make it out. Smaller companies in the U.S., the Russell 2000 index is their proxy. As you see there, down 31% through March 20th. The international markets are down in double digits. And the fixed income markets now as well, if you work all the way down the lower left-hand corner, that very first line item there that we talk about in our meetings regularly, the aggregate bond index, which is the broad proxy for investment grade investing in the U.S., has now turned down a little bit as well. As I mentioned just a minute ago, not only have equities been re-rated, but as you've probably been reading over the last few days, the credit markets had gotten pretty inoperable last week. We'll talk a little bit about that momentarily, but they had turned tougher as well. So you see there now really a wholesale re-underwriting of markets on the heels of what's gone on with the health crisis. So it's been indiscriminate. It's been broad. There really haven't been places to hide. And it's something that, again, we're going to spend a couple of minutes on momentarily, but I did want you to see just those data points to give you a sense of how dramatic the downdraft has been. In that same slide deck, if you turn to page 4, interestingly enough, right, volatility has spiked in quite a pronounced manner. So now you can see there on the right-hand side of this exhibit that we are now at equity volatility levels akin to what we experienced back in the 2008-2009 financial crisis. We don't have, we'd have to confess, we have an expectation that volatility is likely going to remain elevated in the certainly for the foreseeable future. Page 5, just kind of another interesting visual, right? We've been in a pretty consistent and upward trending bull market for quite some time. And you see on page 5 there, just the magnitude of the downdraft again. And now we are, indefinitionally a bear market for equities, given the magnitude of the correction. So I don't think there's any surprises there for the group. If you jump to page 6, this is a little bit of a busy scale or chart rather, I'll confess, but if you look in the left-hand column, the vertical column, these are incremental yields for investment grade for high quality companies. And you can see that they have jumped from a pretty well-behaved environment in 2017, 18, and 19. Investors, right, as you would expect, bond investors are demanding more compensation right now to own those type of securities. The right-hand exhibit is high yield or below investment grade. And you see as well there a pretty pronounced step up in terms of the compensation being demanded. So again, regardless of where you've been, equity or fixed income, it's been rough sledding here over the last couple of weeks. If you jump ahead to page 8, one of the things that you've probably been reading about as well is that the authorities, both on the Fed front, the Federal Reserve front, and now in Washington, have clearly indicated and have begun to act that really no holds are barred here, that they are going to throw every tool in the toolbox and all of their arsenal and ammunition at this crisis. So last Sunday night, you may remember, the Fed kicked that off by reducing interest rates essentially to zero. And you see that step down there in the graph. They followed that up, as you've probably read, with a whole host of liquidity programs designed to stabilize the money markets, the commercial paper markets, the credit markets, the municipal bond markets, you name it. They are throwing all the stimulus they can at this. And I think the intention is to continue to do that. And now it's been joined more recently, as you know. I think as we speak, they're debating a fiscal stimulus bill in Washington that, when all's said and done, may tally close to $2 trillion of stimulus. So there is obviously every intention to give this crisis every financial resources that's absolutely feasible to try to stabilize the environment a little bit and minimize the damage that may transpire economically. As we sit here this evening, it's tough to envision us not having a slowdown, right? We will have an economic slowdown. Its depth, its magnitude, its duration may still be in question, but certainly just anecdotally, as we all read and look around what's going on, there will be a pretty meaningful slowdown here, certainly for the next 2 quarters anyways, if perhaps maybe not a little bit beyond that. And then finally in the slide deck on page 11, if you jump ahead, just as a reminder to the committee, right? I know many of us sitting in on this call worked together in the 2008-2009 crisis and remember how difficult a time that was. We do have these market drawdowns, right? They're not uncommon. They do happen on a fairly regular basis. Certainly the bigger magnitude ones, not quite as frequent, but they happen as well. And kind of what we're experiencing right now is evidence of that, of course. The bottom exhibit, or the bottom half of that page rather, is interesting, right? Because it does show you, we talk about this all the time in our meetings, right? That if we can stomach it, the benefits of staying invested can just be absolute critical to long-term investment performance. And we all know the pension plan has long-term intentions and objectives. And staying invested through time is the best way to generate those more attractive returns. And oftentimes you can get big updrafts even in the middle of bear markets. So I think at our collective peril, right, trying to time with precision in and out of these markets is really an impossible thing to do. We're going to have a conversation momentarily about the portfolio and where it sits today and what we could think about doing from an allocation perspective. But the larger the larger story around staying invested and staying committed and disciplined to our allocation targets, to the extent they still make sense, and I think they do. You see that and pretty importantly resonate on page 11. So that is a lot in the way of collateral. So just to summarize, we will have an economic recession. We're pretty certain of that. We will continue to have volatility in the markets. It's hard pressed to think that that goes away in the immediate future here. We do, I suppose, and we said that the healthcare response aside, because we're not experts in that, we'll defer to those folks. But we do think that over the last couple of days, you have seen in pretty large and unprecedented manner the amount of resources that the government and the Fed intend to throw at this. And, there is the potential for that to be of a magnitude and of a size, at least to stabilize things somewhat. Are we at the absolute bottom of the re-rating? I'm not certain that we are. But history would tell you when you have a downdraft in equities that is 30, 35%, that through time, putting equity money to work in those type of distressed times for the long-term investor is typically proven to be pretty fruitful. So, that's a guidepost, I suppose, for us as we transition our conversation in just a minute to looking at the portfolio details. Let me pause there and see what questions that the committee may have just around the markets, the environment, and the like before we jump into the portfolio.
So, Chris, I got a question for you.
Sure.
You indicated, in your charts that pretty much there's been a broad-based sell-off. So my question is, where's that cash going? Or is this just a fundamental mismatch between buyers and sellers in a market?
Yeah, I think it's a little bit of the latter, Mitch, because if you look at flows right now, it's not like they're all going into, I'm sorry, Eric, I said Mitch. I think they're not all going into, cash because the flows aren't in cash. I think it's a little bit of just a mismatch in a downdraft. I suppose on the margin, there's been a little bit of money into treasury bonds and that kind of thing. But you don't see real dynamic, persisting moves into one area of the market or another. It's a little mixed, I think would be the best way to characterize it. You'll see in a minute when we look at the balances, right, that just the magnitude of the downdraft in equities vis-a-vis fixed income is such that we're overweight fixed income, as you would imagine right now, right? I think everyone probably intuitively senses that, but it's been a lot of unwinding of levered money. There was talk in the markets last week. I don't want to get too far afield from the question at hand, but a lot of the hedge fund community had a levered trade on in the treasury bond market. Without boring the committee with all of the details, but these hedge funds would play the game between the current on-the-run treasuries and the so-called off-the-run treasuries. They tend to trade almost in lockstep with very little deviation, and they lever that trade up and rely on that relationship persisting. And when it breaks down like it did last week and starts to widen, they've got calls, collateral calls and whatnot that they've got to satisfy, and they start unwinding those trades. So see a lot of friction in the markets from that. So there's a lot of technical things going on with money flows also, just trying to respond to the outsized volatility that you're seeing across all markets.
Yeah. And Chris, I just to remind other people on the committee that weren't around in 2008. So, and this will get to your worksheet. But, right now we're about $19.4 million of assets. So in 2008, we before that crisis came through, we probably had about $24 million in assets. We went all the way down to a little over 15 million.
Right.
And since that have come all the way back up to 25 million. So, and through all that, we really never changed our approach in terms of investment allocation, in terms of funds, anything else. So staying the course, over the long haul really has benefited us.
Yeah, and of course, right, Eric, making pension payments all along, right? And also, I don't have the numbers here. I could get them quickly if we need them, but earning it out at an annualized investment return that satisfied the actuarial bogeys, with the benefit of time longer term. So I think, right, it does speak to the disciplines of just staying diversified and invested, knowing that you're going to periodically have these events in the markets that are next to impossible to time. And again, trying to get too precise with calling, bottoms is really just something you can't do consistently. So if you're able to kind of step away from that exercise and challenge a little bit and just think more broadly and say, hey, right now equities are 30 some odd % cheaper than they were a month and a half ago or thereabouts. We know we've got economic challenges near term. We all agree with that. But fundamentally beyond that, I guess I maybe have an optimist attitude about this, but when the health crisis is becoming to be manageable and maybe we can turn the corner towards the end of the year, I think things can come back relatively quickly. Again, I say that with obviously no guarantees or special inside information, certainly. We've got our challenges ahead, but this has often been the time where if we've got the wherewithal, stepping back into equities a little bit and being a minute on the schedule, we're not talking about doing all of it, just a part of it, has been a nice discipline that's rewarded the long-term investor.
Sure. So anybody else have a question? If not, then I'd say, Chris, why don't we move over to your cash flow worksheet and what your recommendation is?
No other questions from the group?
Yeah.
Good. Barbara, you're good. Mitch? Paul?
Yep.
Yes.
Let's bring up that spreadsheet, if you will. Hopefully everyone can make it out there. So I know John was asking us offline. I think we've got a lump sum to accommodate. So we've worked that into the calculations as well here. But what you can see is if you work your way down, I'm about in the middle of the exhibit, and I apologize, the font's a little small, but you'll see the current allocation and then the blue highlighted a vertical column with the target weights. And if you make your way down to your first big entry there, fixed income, right, we're run with a target of 38%. You can see by virtue of what's going on with equities that we're all the way up right now to 45% fixed income. Because while fixed income has been challenged, as we talked about, not nearly to the extent that equities have been. And then if you kind of work your way down where the requisite underweights in the equity categories, most prominently, right, both domestic and international. So we fashioned here for the committee's consideration an exhibit that redeploys, if you do the arithmetic, and in the far right you see the resulting balances, deploys about half the existing overweight fixed income back into equities, and alongside that does the liquidity raises we need to do for the next month, including the lump sum payment that we just talked about. So we're trying to satisfy, 2 or 3 concurrent objectives here, most notably, obviously, the higher level rebalancing, but also under the hood, getting you some of that liquidity that you need to satisfy payments coming up here in the immediate future. So I don't know what thoughts the group may have or comments or concerns. This is over the last week. we've been on these calls with folks like yourselves, as you can imagine, each and every day, all day. I think most committees have been pretty receptive to putting some type of foot in the sand on a rebalance. This kind of, 50% type approach has been pretty popular. And I think it does two things. One, it addresses the imbalance, which of course is important, but moreover, it leaves a little bit there tilted conservatively just to give us collectively a chance to catch our breaths and see where the markets may settle in over the course of the next couple of weeks here. As information, as you know, is very fluid and developments are seemingly, happening on an hourly basis here. The markets will continue to react and likely bounce around here a little bit. So with that, let me pause and have folks have a chance to look through that and see if there are questions or comments or thoughts.
Chris, my concern, my question really, I'm looking at the blue bar in the middle that I realize not everybody on this call can see, that shows current target allocation. And so the column just to the left of that's where we're at, and the column to the very right is where we're going to get to if we agree with your recommendation. Is that correct?
That's correct, Mitch. Yes.
Okay. So therefore, we're not bringing any of these areas into the exact target. We're just making adjustments to make them closer.
Yeah, again, the thought, right, is we don't have to do all of it right now, right? We recognize that the markets are still a little bit, a little volatile, and there's still, lots of things being processed, but we've had a big re-rating. Let's take advantage of that and the margin anyways for a portion of the overweight. And then we'll collect our breath here and come back to you as we see things fit over the course of the next couple of weeks or more, more rapidly if need be. And, we can revisit that second half and see where things develop. It's kind of a middle of the road approach, if that makes sense.
Okay. And then the second question or last question for now is just, and you're looking at making no adjustment to the real estate, even though that is below the target.
Yeah, we've got, Mitch, that we've had that Morgan Stanley strategy on kind of a little bit of an internal watch. And I'm just talking to the research department as recently as Friday afternoon. They're working through some ideas on that front and, promised to come back to us in short order. So my inclination is I think I'm okay if the committee's okay being a little bit underweight the target weight right now in that particular strategy.
Okay, thank you.
Okay. Any other questions of Chris as to the recommendations?
No.
No, Paul, you're okay?
No,
Okay.
fine.
Well, if there's no other questions, I would entertain a motion to accept Chris's recommendation and that we can act on it.
Also move.
Okay.
I will second.
Second, great. Any other discussion or questions? If none, those in favor signify by saying aye.
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 Any opposed? Any abstentions? Okay, then I guess we got it passed. So thank you.
That was Paul that made the motion, right?
Yes.
Yep.
Okay, thank you.
So Chris, if you can forward to me from your department all the worksheets to execute, I'll get those signed and forwarded down to Wells Fargo and everything.
Chris, you hear?
Yep, Mitch, Eric was breaking up a little bit, but I think I got the essence of the question. We'll get the paperwork out to you.
Yes, that'll be fine.
Super. Thank you, folks.
Okay. Anybody have any other questions, comments for the committee? If none, that was the only item on our agenda. So let me just double check. Yep, that was the only item we had. So in this case, I would entertain a motion to adjourn.
Motion to adjourn?
Is there a second?
Go ahead,
I'll
Paul.
second.
Those in favor? Aye.
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 Okay, so we're adjourned at 7:28.
Everyone stay safe.
Yep,
Thank you.
too.
You
Thank
too.
you.
Eric, thank you.
Okay, thanks for setting this up, Mitch.
Yep, take care.
Bye.
Bye.